Hello YouTube Nation, Sky Hyper V here. This is my first video in what I hope to be a long series of instructional investment and mathematics videos. This channel is going to cover quite a few topics revolved around investments. That means either stocks or crypto trading, options, stock, equity space, commodities, things like that. And then I'll also put together some mathematical videos as well on public private key cryptography and go through some of the things that are related to kind of the crypto space. So I'm hoping that you stay tuned for some of my upcoming content. But today is my first video and it's going to cover cost basis. One of the key tenets to success in investments is tracking your cost basis, knowing it from a unit perspective, and I'll get into what that means a little bit later. So let's get started. Today's topic is cost basis. Cost basis is essentially your unit cost for any given asset. So if you have a product X, if you can reduce the price of that X while you own it, you're going to profit regardless of what happens to that price. Granted, hopefully it doesn't tank, but if you have a pretty stable asset and the cost of ownership carries some risks, right? Because it can go down, and at the same time, your capital is not really liquid because it's tied up in that asset. So you really need to make that asset work for you. And the best way to get that asset to be a valuable asset is to reduce its cost. But before you can reduce its cost, you really have to understand what it cost you, right? And that cost is somewhat a mystery to a lot of people because they only track what they paid for that particular asset and don't keep in mind all the extra things that go around it. So let's take a look at this topic from two examples. We're going to do two examples today. One is going to be on using a stock as an example. And then the other example will be using a crypto coin. So let's get started with the stock example. Okay. Let's say you invested in some company called XYZ. So now you have some XYZ stock. Let's assume that stock is trading at $100 per share. Okay? You bought 100 shares of it. So now you have spent $10,000 invested in XYZ because you have 100 shares. So your cost per share is $100, right? That's what it's trading at right now. But in reality, that's not how the world works. You can't buy and sell assets for free. There's this pesky little thing called fees. Exchange fees, brokerage fees, whatever you get hit with comes out of pocket. So you have to track that as part of your cost basis to know whether you're in profit or not. So let's look at an example with our current state where we have 100 shares of this $100 stock. So we spent $10,000 on it. So our break even, you would think, is at $100. Meaning if the stock stays at $100, we're sitting okay. We're not underwater. But brokerages are going to charge you fees for buying and selling that stock in the form of some fees. Let's assume that your brokerage has a $5 flat fee. Flat rate at $5 to buy, a flat rate of $5 to sell. So you just bought 100 shares. So you really spent currently $10,005 on those 100 shares. So you're thinking, okay, well, my cost now is divided by those 100 shares. My cost is really $100.05 per share. Okay, sorry, $100. 100 shares need to be divided there. But like any asset, its value as it goes up, down, sideways, and you want to essentially sell that asset, so that's going to hit you with a fee as well. Remember, our brokerage charges a flat $5 rate. Okay? So you now have spent $10,000 on the original 100 shares. Plus $5 to buy. And now you spend another $5 to sell. Bringing your grand total so far to $10,010. So what does that mean from a cost basis perspective? With our 100 shares, our average price now per unit, per share, right? I say unit because in this case, unit is a share, but in crypto, it may be a coin, in currencies and whatnot, or gold, it may be an ounce, or whatever it may be. So our per unit cost right now is $100.10. That is what is called our break even. Right, initially we spent $100 per share and we spent $10,000. So really we can't think that stock trading at $100 is quote unquote a break even or we're sitting pretty. We're actually underwater. Imagine you buy that stock for $100 and you immediately sell it at $100. You didn't break even. You just spent $10 on that round trip because of those fees. So you're actually at a loss. If you were to do that over and over again, you'd go broke pretty quickly. So if that stock sits at its current price, we're at a loss, right? That stock has to gain 10 cents for you to break even. That is cost basis. It's finding your break even point, your point of profit, your point of loss, things of that nature. So a lot of people ask me when I'm chatting online about cost basis, and they say, well, my block folio or my portfolio shows I'm green. Well, if you put in how much per share or how much that coin costs you in Bitcoin or whatever it may be, that conversion, and you put that into your portfolio, it's going to just say you bought X number of shares or X number of coins for this price and now it's up, so therefore you're in the green, or it's down and you're in the red. But that app has no concept that you had a fee associated with that. So really, you can't say that you spent $10,000. If you were to put that you put $10,000 into your portfolio, that's how much you spent on these X shares, on these 100 shares. The moment it goes up a penny, that app or your portfolio is going to show you in the green because you're up a penny. But we know, right? I'm drawing these arrows here at the $100.10 mark. We know that that is not really a profit for us, right? If that stock trades at $100.01, we're still underwater. It trades at $100.05, we're underwater. If it trades at $100.09, we're underwater. You get where I'm going with this? Right? Fees make a huge impact. Even if you're a long-term investor and you're not buying and selling constantly like a day trader would, it's still very important to track this. Because as I mentioned, those fees and the cost of doing business in the world today, in the investment world, is not free. That cost comes with some baggage that you then have to account for in your portfolio. So how do we reduce our cost basis on something like a stock? I own it now. I own XYZ, 100 shares of it for $100.10. Remember, not $100. So if you talk to somebody like me, I've already factored in fees. So if somebody comes to me and says, what's your cost of this stock? I'm going to tell them $100.10. Forget the fact that I bought it at 100. And then forget the fact that it's still at 100. Have to factor in the fees. That is my cost. that lets the counterparty know, or whoever I'm having conversation with, that I'm technically not in a profit. And that is in fact the case. So there's several ways for us to reduce cost basis when it comes to stocks. Okay? If the stock goes lower, buy more, right? This is what's called averaging down. Now, if you initially bought the stock in a company that's reputable, Apple, Microsoft, and you feel like it has longevity, then going down, and if the stock goes down and you average down, that may be a prudent thing to do if you want to have more shares of it. We're not going to get into those details right now around the math around that. The second thing is there's an options world. There's a derivatives world of options where you buy and sell calls and put contracts, and you can lower your cost basis that way. I'm going to have a video on options. As I mentioned, this channel is going to revolve around a lot of investment things, and derivatives are part of that, the derivatives market. So I'll have a video on options later. But we're going to talk a little bit about, let's say, dividends. Makes our math easier for the purposes of this video. Okay? So if company XYZ that you just bought pays some quarterly dividends, that's free money, right? That's money that is paid out to shareholders by an organization that is typically stable. You're not going to see the Amazons and Facebooks and things like that pay dividends because they're in a growth phase. I mean, they're tech companies. They haven't been around long, relatively speaking, compared to the Microsofts and the Apples of the world. So they don't pay dividends. I mean, you are buying those stocks straight speculation, and you hope that they go up, and you're paying a premium for them for that growth potential. But if you have a company like XYZ, for example, that happens to pay some dividends, they pay dividends quarterly. Okay, so every 3 months, you're going to get paid some amount per share. So let's take a look at the math around that. So remember, let's just quickly outline here that my cost per share on XYZ is still $100.10, right? Remember those fees that came into play, round trip. So if XYZ pays me a dividend of 12 cents, and let's say 3 months have passed by. Let's also assume, let's assume that we got paid this, but let's say that XYZ is actually trading at currently still at $100. Let's say it hasn't moved in 3 months. They seem to be having an issue with growth. But we're confident, right? The stock that we bought, because we did our research, we're disciplined investors, we like the company, we're gonna deal with its ups and downs, but we feel like it has potential, so we buy the stock. And while we sit and wait for that stock to grow, we just keep collecting dividends. I mean, that's the beauty of getting into stocks that pay dividends. And I'll get into that kind of stuff in later videos as well. So the stock goes ex-dividend and has paid you 12 cents for every share that you own. So you come along and you know that you initially spent $10,010 on the original purchase. Remember, you didn't really spend that extra $5 yet. You actually have spent $10,005 because you haven't actually sold yet, right? You only bought and it's in your account right now. But we have to keep track of the sell side. You eventually got to offload these shares if you want to make money off of it. Not going to just sit and hold forever, presumably, right? So we're just going to track, for a cost basis perspective, this number right here. We have to track the total round trip. But the cool thing now is we know that we made $12 from the dividends because it's 12 cents. We own 100 shares. So the company paid the broker $12, and that broker then obviously divvied up the owners of that stock and paid them 12 cents per share. So without any trading of that stock, just buying it right now, keeping in mind my full round trip cost, I am now at $9,998 of cost ownership. That is my cost basis from a whole perspective, my entire 100 shares. But let's go ahead and divide that. Okay? So we're taking this by 100. So my new cost per share is $99.98. Now, just a side note, in the stock world, when a company pays a dividend, the stock does go down by the same amount as the dividend. But again, remember, you're hoping that your investment XYZ is that stock continues to rally and comes back. You have to be bullish if you're going to buy it in the first place. You don't buy a stock and you just sit around going, well, I kind of hope it goes up. I'm not really that confident. So why are you putting your money in there in the first place, right? You're buying a stock because you're bullish. So when the company pays a dividend, now let's assume that at some point, 2 months from now, 2 months goes by, and the stock is now trading at, it went down by a penny. Your original cost per share of the stock was $100. Counting fees, and now your dividend that you just got paid for waiting 3 months, you're now in the green, right? The stock is trading at $99.99, and that's cost basis reduction from a perspective of the stock world through dividends, and then the other things I mentioned, which is you buy more to average down, or you use options, which will be covered in later videos. So all this money coming into your account from a perspective of dividends factors into your overall cost divided by the shares, and you got your per unit cost, right? This is your per unit cost. This is critical because when I have a portfolio and I know that this is how much I spent per share, when I look at that unit, how that stock is trading, if it's trading at $99.99, I already know I'm in the green. Maybe my P&L may now reflect that because of the way it was entered into the app or how my broker tracks it. Brokers do the same thing. They may show your year-to-date gains at some green value, $100, $200, maybe you're up $1,000. But if you paid $1,000 in fees over the time, your cash balance is going to go back to where you started. So you spend a year trading and you spend all this money on fees, but you didn't really track them, the broker is going to say, great, you did a good job. Okay? You've got some profit of $1,000, but the fees themselves cost you. Let's take another look and another example using cryptocurrencies. Start a new drawing here. Now, we're going to talk a little bit about cryptocurrencies and how do you reduce cost basis. What is cost basis as it relates to cryptocurrencies? I just started getting into cryptocurrencies about a year ago. It's my background, right? Cryptography, mathematics, comp science. So, I just kind of fell in love with the space. It's new, it's booming. A lot of people are partaking in it. It's exciting. And it's a great tech. I mean, really at the underlying, the blockchain technology is phenomenal. So I'm going to use one of my current favorite examples of crypto. All right, I'm just going to refer to it as crypto going forward here, cryptocurrency. Let's look at this coin called B3. And I should give a shout out to the whole B3 community. I just purchased this coin, I don't know, a few weeks ago, and very, very strong community. Their mods on the Discord channel doing a great job of policing the content, great job of marketing. The devs are doing a great job. All the community people just volunteering, helping each other. It's a real cohesive environment. I haven't seen anything like it before. It gives me confidence in B3. And so I'm invested. One of the things you're going to hear from me on these videos is I will mention things that I'm invested in. I'm not shy about that. right? It's not a promotion. You can take it if you want it that way. I'm not going to sit here and promote things that I'm not into, but I will use examples of things I actually own. Because like I said, I don't mind saying good things about things I own because I do my research. So let's look at B3. Again, a coin with a lot of potential. So hopefully in the next few months, we'll see a lot of great news and milestones being hit time after time after time, and we can get some returns off this coin. So B3 is what's called a POS coin. Okay, this is a proof of stake coin. I am going to put videos out there about proof of stake versus proof of work. It's not the point of this video, but I'm going to go over the very basics now, and then I'll cover more detailed discussions around this specific topic of what these coins mean and how they interact with the marketplace and how they give rewards. But proof of stake is essentially like dividends. You know how that Apple stock or some XYZ stock paid as dividends? Well, for securing the network and staking our current wealth or coins, the blockchain rewards us. And that reward can be set by the developers in the code at some frequency, and that frequency can decay over time at certain blocks when it hits. But right now, B3 is in a very, very high proof of stake phase that is there to promote growth, and it's done a phenomenal job, because if you're joining or if you're on the Discord chat of B3, it's pretty nuts. I mean, people are excited about it. I got excited about it. I'm a very disciplined investor, so it takes a lot for me to be emotional about something. I'm not a roller coaster guy. When my portfolio is down, I'm not weeping. My portfolio is up, I'm not jumping around. I just like steady gains. But I'm very excited about this community and this project. So, as I mentioned, B3 is currently in a very, very high stake phase. It is generating 10,000% per year ROI. ROI is return on investment. 10,000% per year. Now, granted, that phase or this phase of 10,000% per year is about to end in the next 10, 12 days, or I'm sorry, in about 18 or 19 days once it hits block 80,000. But it is currently in that phase right now, so I'm just going to use those numbers. That's roughly about 27.5% returns per day, okay? So let's look at how we reduce cost basis if we were to buy or invest into B3. So let's take an example similar to the one we did before. I put $100 into B3. And I'm going to use some numbers from a few days ago, so these numbers may not be accurate as far as what's in the marketplace right now, but just for the purposes of the example and following along my script here, so I give you the most accurate content, I'm going to go along with a little bit dated information. So you spend $100 US dollars on B3. Currently, it's trading. So there's $100. It's trading at, not currently, at 3,000 of a penny, okay? So that gives you roughly around 33,333 coins. Now keep in mind that that $100 you actually spent also has the cost of doing business. So you've actually spent $102. Okay, so we're going to estimate that our fee, let's estimate that our fee was around $2 for the exchange. We did, this and that or whatnot. Let's say round trip is about $2. I may be estimating a little bit high here, but just for the purposes of the example, because you can do math in various ways based on your situation. So let me just adjust this here. $102 at 3,000 of a penny, you get roughly 33,333 coins. Okay. So now what do we do? Do we just sit on our hands and hope that B3 goes up? I mean, it's got to go up, right? But what if it doesn't? What if it doesn't right away? But we have a long-term hold on this. We're confident, just like we're confident in XYZ. So if it goes sideways, it goes a little down, while we wait for that organic growth, while we wait for these, phenomenal developers in the community to continue growing this coin to a higher valuation, we're not going to just sit around. Our money's tied up in this asset, just like our money was tied up in XYZ. So we need to continue to make our money work. We cannot, as savvy investors, allow our money, our hard-earned capital, to be tied up in assets, and that asset is not working for us. We don't just throw money in the bank and just hope that it grows through some magic process and the company grows. Now, granted, that may happen and it's great, but you need to work at reducing your cost basis. So let's spend some time reducing our cost on this particular coin. Now, as I mentioned, this coin is a proof of stake coin, okay? When you stake your coins through your wallet for B3, it's going at some interval. It's random. The more coins you have, the more chances you have to stake and whatnot. So, typically you have to have a lot of coins, where you join a community pool or whatnot, and you just do a pool sharing, so everybody wins for smaller wallet holders. It keeps spitting out 27.5% per day rewards at some fixed frequency, right? Also variable frequency, 24 hours, 36 hours, 48 hours, whatever that may be. But we're just going under the assumption it's 27.5% per day. So we have 33,333 coins, right? After day one, this is representing 27.5%, by the way, 1.275. So after day one, our wallet now has 42,500 coins, just because we staked them, right? This is our new holdings. This is how many coins we currently have in our wallet now. So what is our current cost basis? We know that we spent originally $102 because of fees and whatnot. And of course, you do round trip and all that good stuff. And you know that you've roughly spent $102. You divide that by 42,500, and now you get about 2.5 thousandths of a penny. This is your per unit cost. Per unit cost. And in the case of our stock example, the unit was a share. In this case, it's a coin. Now, look at this interesting thing. The coin, we know, at our previous example, was trading at 3 thousandths per coin. Your new cost is roughly a little bit, 2.5, or to, let's just say 2.5 thousandths of a penny. So what have we done? Look at the difference between this, right? From a purely staking perspective, our cost per coin has gone a little bit lower by about 20%, actually not a little bit lower. Because of a high rate of return from this coin on that day, we have reduced our cost basis by 20% in one day. That is from 3 thousandths of a penny to 2.5 thousandths of a penny. And the next day, your coins are going to grow even more. So assuming that that coin hasn't dropped by more than 20% that next day, you're sitting really pretty. This is how you generate wealth, right? The beauty of crypto world, as it relates to proof of stake coins, is that when you stake coins daily, every few days, weeks, however long it takes you to do that, other people may grow at a faster rate because they're staking more. That's not the point. The point is, what is your cost basis? So those earnings compound into larger earnings. You could see I grew by almost 9,000 coins in one day in my example. The next day will be even higher because now I have a higher input. So that same percentage of a higher amount is going to generate more returns. That compounding earnings is reducing your cost basis because you now have more of it. For example, if I have some asset that costs me some amount of dollars, and now I'm able to duplicate that asset or make it grow and replicate it at no cost. In this case, proof of stake didn't cost me anything. I left my wallet open and the computer did its job, right? The blockchain did its job. It is a very effective way to earn wealth. And it's absolutely critical for the success of your crypto investments to track a per unit cost. Because again, going back to that stock example, if you were to put $100 that you spent, that thing may show green or red, who knows? It depends on a static value that you put in. You have to enter your fees. So initially you're gonna look red because let's face it, the moment you buy something, you already at a loss because of the fees. We looked at that in the stock example. You're down by 5 cents or 10 cents on the stock. Here, because of the $2, it's negligible in the world of crypto here because you have so many coins, but you're still down. If you were to put the right numbers in, you're gonna see red for sure the moment you enter. You're just hoping for growth. Well, that growth can come in the form of a coin growing in value, or you can grow the amount of coin. So if a coin stays fixed at some value, or it trickles down a little bit more, or it even drop by 10 or 15%, we have no worries because our investment grew by 20%. Now, granted, we have to sell it to secure that, but this is why I emphasize the per unit cost tracking, because it immediately lets you know when you compare to what it's trading at right now. If B3, my current unit cost on my holdings of B3, okay, I'll put it up here. All right, my B3 is 3 sats. These are Satoshis, okay? So a Satoshi is 100 millionth of a Bitcoin. Today, I believe that B3 is currently trading at around 16 sats, maybe 15 sats, somewhere around there. But look at that. So how do you keep your emotions in check? It's through mathematics, to truly understand where you're at. Because if you see a coin go from 50 sats down to 16, but your cost basis is 3, sure, you're a little worried, but not really. Because why'd you buy in the first place? You bought for growth. You believe in that coin. You believe in that asset, that investment. So if B3 trickles down to 12 sats or 10 sats, I'm not really that worried. I don't let the emotions get a hold of me. So why is all this important? Well, I hope you guessed it by now that you don't have to be a genius to know that if product X costs you some Y amount, that you have to lower that Y value. You have to make sure that you continue lowering it through all the various methods I've showed you in stocks versus crypto, and your investments will prosper, right? I cannot stress this enough. Track your cost basis. When it comes to taking profits by selling your shares or your coins, you have to know where you stand at a unit level. Not high level, green or the red in the P&L, because apps, portfolio apps, as I mentioned, are not unit specific. They're agnostic to that. They're agnostic to your fees that you paid. They don't know what your fee is going to be. You have to factor that in the moment you put it in, because when you decide to sell, it's going to impact you. I mean, you got to pay the piper. So you might as well track that overall right now. Because if you don't track it and you think you're in the green, the moment you sell, you're in the red, or you broke even and you wonder why you didn't make any money. It also helps you let you know when you can sell, because I know that if some asset is trickling down to close to my break even, maybe I need to scale down a little bit, right? And I can't know that what my break even is if I can't track my cost basis. So that's what I say when I say cost basis. It's not, I spent this much. Well, how many coins do you have? How many shares do you have? Did you get paid any dividends? What's the income? What's the money coming back, or the growth of the coins from a coinage perspective? How many you have? That all matters, because every day that goes by, this coin is growing at 27.5% per day, and as long as the coin doesn't dip down by consistent 27.5% per day, I'm doing okay. So again, you have to get granular and track aggressively. It's a lot of work. We went through these examples, but when is making money and keeping that money not work? I want you to leave some questions for me in the comments below. I'm going to make a special edition of this type of video, but it's going to be answering just the top questions. So post them down there in the comments. I'll make a cost basis question and answer special edition. If you have a question and you're into crypto, leave your public address, right? Leave your B3 public address down in the comments with your question. If I pick your question for my next video, for that Q&A video, I'll send you some B3. Until next time, folks. Peace.